The 30-year Treasury yield recently hit its highest point since 2007. Hidden inside that single number is the baseline borrowing cost on trillions of dollars of global debt. It is the actual price of money. As you can see in this diagram, a bond's price and its yield move in opposite directions. When buyers pull back, the price of the bond falls, forcing the yield to spike to attract new money. Right now, yields are rising across the board, making new debt incredibly expensive to issue and old debt harder to service. That sudden, steep increase in the cost of borrowing is starting to fracture a specific $2 trillion corner of the financial system, the private credit market. Credit stress is materializing fast. Look at this chart tracking middle market corporate default rates. You'll see a sharp, vertical spike pushing the default rate to 6%, the highest level ever recorded for these private borrowers. Yet, if you listen to the lenders managing these private credit funds, everything is fine. They are publicly reporting massive incomes and insisting their portfolios are completely healthy. They are even mailing out hefty, consistent cash dividends to their investors, completely unfazed by the fact that the underlying companies they lent money to are failing to keep up. Wall Street veterans are skeptical of this optimism. On a recent earnings call, J.P. Morgan CEO Jamie Dimon noted the cracks forming in private credit, saying, "When you see one cockroach, there are probably more." That leaves us with a mathematical contradiction. A $2 trillion industry cannot sustain massive cash payouts to its investors, while the businesses actually writing the checks are going broke. To understand why these companies are failing, look at the terms of their loans. When you get a mortgage, you lock in a fixed interest rate on day one. But the private credit market runs almost entirely on floating rate debt. This chart tracks SOFR, the benchmark for floating rate loans. For years, it sat near zero. But as it spiked over 5%, corporate interest payments rose in lockstep. Take Pluralsight. Their billion-dollar floating rate debt payments swelled until they completely eclipsed the company's actual cash flow. The aggressive rate hikes eroded whatever profit margins these companies had left. It pushed an entire class of heavily indebted businesses into structural insolvency. They simply do not have the cash to make their monthly payments. When a borrower like Pluralsight runs out of cash, lenders use a creative accounting maneuver called a payment in kind, or PIK feature. In a PIK arrangement, the borrower stops paying cash. Instead, unpaid interest is stacked on top of the original principal, compounding the debt. By forgiving the immediate cash payment, lenders bypass the default trigger, legally stamping this bloated, unstable loan as a fully performing asset. Many of these private credit funds operate as business development companies, or BDCs. To maintain a tax-exempt status, the government requires these specific funds to distribute at least 90% of their taxable income back to investors. Because the unpaid interest is added to the loan balance, the BDC records that newly capitalized debt as top-line income, even though not a single physical dollar actually changed hands. So the fund generates phantom income on paper, and because of their 90% distribution rule, they are legally obligated to mail out real, tangible cash dividends to their investors based on money they never actually collected. This accounting maneuver is spreading fast. Over 11% of all private credit loans now rely on payment-in-kind arrangements just to keep borrowers afloat. Because these loans aren't traded publicly, funds use subjective Level 3 accounting models to appraise their portfolios. This allows them to avoid writing down the value of assets that have effectively stopped paying them. But there is a hard deadline approaching. This timeline shows $85 billion in private credit debt maturing between 2026 and 2029. When due, these companies, carrying massive PIK-inflated balances, must refinance at today's higher rates. The math that broke them initially will hit them again, on a much larger principal. You can hide a loss in an accounting line, and you can roll unpaid interest into a bigger balance, but the underlying reality of cash flow is absolute, and eventually the bill comes due.